The unfortunate truth is nobody really cares about your financial well-being, unfortunately. I'd like to think eventually that they're going to be teaching this sort of thing in schools, because nobody is going to provide for you when you can no longer work for yourself. The old days of working somewhere for your whole life and hoping that that company will take care of you in some sort of a pension, it just doesn't exist anymore. So you are responsible for you. And if you want to live off something more than what the government allocates towards your lifestyle when you are done working, then you have to figure that out. There's really two main sections of this video. One's going to be explaining exactly what a Roth IRA is. So if you know what that is already, this part's probably going to be pretty boring and you may want to skip. Use the little guide down below, sort of fast forward to another section that may make more sense for you. And then the second part is going to be, how long would it take for you to save $1 million in a Roth IRA account? Well, if you see the plate behind me, try not to mind the snack. I'm trying to do this at lunch. Listen, the whole point of this channel is for me to help you on your investment journey. Would love for you to join along if you're into that sort of thing. Subscribe, as most of you are not. So good. You know, I'm not really here to flex, but I did just pass 50 subscribers. So my stats are telling me you are probably not subscribed. Quick overview of a Roth IRA. It's not actually an investment. It is an account that holds investments. So obviously there's a lot of things you can invest in. Stocks, bonds, options, mutual funds, ETFs, commodities like oil. There's a lot of things, real estate. Well, if you're new to investing or savings or working or whatever, you may not really comprehend how much taxes can... I don't know if it's just me getting older or what, but I really hate taxes. So if you're not there yet, good for you. You can invest for retirement any way you want. The government just created a few different types of accounts that you can use to put your investments in, so they're taxed differently. So a Roth IRA is one of these retirement accounts. It's taxed differently than what you would have been taxed otherwise if you would have just held these investments in a regular account, like an individual account, a joint account, a trust account, what have you. Now, although this video isn't designed to help show the difference between a Roth IRA and traditional IRA, a quick difference between the two is a Roth IRA, the money you put in has already been taxed. Just like if you get a paycheck from work, you likely have already had taxes taken out of it, and so that money is considered after-tax money. So that is the type of money that you use to put into a Roth IRA. There's no tax deductions at the end of the year, as that's part of the way this investment account works. Real quickly, this is sort of the order of things. You're going to first open up a Roth IRA account. Now, you can do that at a lot of different places, just like you can open up a bank account at a lot of different banks. There's Bank of America, there's Chase, there's Huntington Bank, Comerica. There's a lot of different types of banks and credit unions, depending on where you're at around the country. Same thing with brokerage accounts. They're also considered custodians of your investments. Lots of different custodians that are out there. There's Merrill Lynch and Charles Schwab, and there's Fidelity and TD Ameritrade and Vanguard, and there's these younger, newer companies that have the smart, cool apps for everybody, Webull and Robinhood, and there's a lot of them, just like there's a lot of banks. You just have to open up an account somewhere, and it doesn't really matter which one. I have my own preferences of which ones I think are better, but also not talking about that in this video. You find your custodian that you want to open up your Roth IRA in. Then you deposit money into that account. Now, there's a limit each year that the government allows you to do, and this year in 2021 is $6,000. Unless you're over the age of 50, they give you a catch-up period, because saving for retirement at 50, I mean, it's not too late, but it's kind of later than you should have done. So they let you catch up and add a little more. But it's $6,000 for a normal contribution, a $7,000 if you are catching up and over the age of 50. Now, after your account's open and you've put money into the account, now you can go and purchase investments. It's technically not you buying the investments, it's technically the Roth IRA buying investments. Not to get confusing right now, but you can have non-traditional type investing where you have a Roth IRA in the name of sort of a trust that goes out and buys investments on your behalf too. You can buy things that aren't just on the public markets. You can go and buy a private business, or you can buy an investment property, or you can buy gold or paintings or collectible cars. There's sort of a lot that you can invest in. I don't want to overcomplicate things, but I think it's important to know there's more options than what you may have been led to believe you can do. I'm going to stick with the traditional way of doing things because it's not as complicated to sort of get an understanding of how a Roth IRA works and what it takes to become a millionaire. So you open up your account, make a deposit, which is considered a contribution into the account. You can only do so much per year. And then you go and purchase investments into that account. Now, a lot of these custodians go to the public markets. So you're able to look at stocks, bonds, options, mutual funds, ETFs, and the whole gamut. So then you go and you buy investments in that account, or you can keep cash in there. You get to decide whatever you want to do. You can still deposit, contribute $6,000 every year, or depending on the IRS may change that. Typically, they've been making it a little bit bigger each year and more money you can save for retirement. Hopefully, you pick investments that grow over time. And when that happens, that's when you're going to see the advantage of investing within a Roth IRA as opposed to just investing in a regular account. When your investments have been sold and put back to cash, that is considered a capital gain, and you're going to have to pay taxes on whatever amount of money that you made on that investment. There's actually a lot of different factors that come into how much you're going to pay for taxes. One of the biggest factors is how long you've held the investment. Fact is, government's going to want some money from you making money with your investment. However, if this was done within a Roth IRA, you don't have to pay taxes on any of that gains, even when you pull the money out of the account, as long as your retirement age, according to the government, which is 59 and a half right now. That may change though too. I mean, all these factors sort of change over the years. But as long as your money stays within the account, buying and selling, you are not going to be taxed on that. So you can make investment decisions throughout your investment career, not worried about having to pay taxes on this money, because that's a big hit whenever you sell one investment to go purchase another and have to pay a percentage of that in capital gains. This can be such a huge advantage when you're saving over your lifetime, and that's why the government limits the amount that you can put into it, because they are losing a significant amount of revenue due to these retirement accounts. So take advantage. Get an account started if you don't have one already. If you're in a lower tax bracket or if you're younger right now, it's a perfect time to get started in investing, and the Roth IRA I think is one of the best ways to do it. But obviously there's a lot of different factors that involve, and there may be different ways you should be investing or different types of accounts you should be using depending on your personal situation. So I'm always going to recommend that you talk to a professional. But I think for most people, if your income's low, if you have a low tax bracket, this could make a lot of sense. Now, the government's limited us to put $6,000 a year into this account. Comes out to about $500 a month in savings, or $16.67 a day. I sort of nerded out on this. I like to make charts and graphs and use Excel. Let's take a look at some of the numbers. Like, what does it really take to grow a small account to $1 million? What sort of returns do you have to get, and how long would that take? I'm assuming that you're really young right now, so let's start at the age of 16. If you're 16 and you're putting $6,000 a year right now, which is the maximum that's allowed, I broke down what that looks like on a monthly basis versus a daily basis, and I'm assuming a 7% return in this example. And that's only because that's what the market's averaged over the years, adjusting for inflation, mind you. Because if you're not looking at inflation, it's somewhere between 9 and 10% a year, the returns that you're getting. But I want to know how much in today's dollars I'm going to have in the future. So taking into account inflation, if we just invest in the market overall, we're averaging around 7% return. I feel like I have to give a disclaimer on this because obviously this is not how the market works. It goes up and down a lot. This can be stressful, especially if you're a conservative investor. So these numbers are just to help us understand the power of investing on a regular basis and what can happen in the future by starting early and being consistent. But by no means is this going to be what happens for you, to you. It all depends on what your investments are and how they return. But anyways, let's continue on. So I just put in these limitations here for me. Like, I understand this is changing every year, it seems like, but $6,000 a year you can put in. If your age is 50 or older, you have that catch-up period. This is what I'm assuming when in this chart. I'm assuming that the yearly savings is added in a lump sum at the beginning of the year. So I didn't get into all the fanciness of adding each amount per month or per day and then assuming you break down a 7% return over a monthly basis. What is that? What happens? I mean, there's a lot of factors involved, and I understand that. You get it. It's not perfect science. It's just, to help encourage us, to motivate us, to let's get going. Let's do this thing. Let's invest something. I have the age here, how old you would be after the first year invested. So you put $6,000 in with a 7% return, you're going to be at $6,400 at the end of the year. And then I assume that you were saving that whole year in a bank account, and then you just added $6,000 to that. And then throughout that whole year, that whole sum got another 7%. And so that brings you to 13,000. And then the next year you added an investment return of 7%, etc. You get it. This is how old you are. It would take you about 11 years to have over $100,000 in your investment account. And you can see how that compounds over time to where your $1 million mark hits 37 years later. You would be age 53. Now, to be straight with you, I've met with a lot of people. I've been in the financial services industry for nearly 10 years, and that's a lot of money. I mean, I've met people that have got quite a bit more than that, but I also know that that's not average. Most people in their early 50s do not have $1 million in a tax-free account. Let's look at a couple different factors just because that's fun. Instead of starting at 16, maybe you wait till after college, or you just want to make sure you have a good job. You wait till you're 25. So the same thing here, except for you to be a millionaire, you will be 62. But let's say you can invest better than the market, although that would be really hard to do. I'm confident in you. Your returns make a big deal. Obviously, they may be smaller than this, or they could be more. Let's say instead of getting 7%, you are getting 11%. With that 11%, instead of having to wait till 62 to have $1 million in this account, you are now 53. With just 4% more per year, you have increased the amount of compounding in your account, which helps tremendously. And if you're a crazy investor and you can get 25% per year, you should be famous. You would have your first $1 million within 16 years in a tax-free account. You would be the age of 41, assuming you started at 25. However, you would also have over $100 million by the age of 62 in a tax-free account. And you would definitely be one of the most famous investors of all time. I don't want this just to be educational, but I want it to be motivating. I know this sort of thing can be intimidating, but there really is nothing better than stumbling through it, and learning along the way. So open an account, get started, and just as questions arise, look them up and figure it out, because you are in charge of your own future. So you got to figure this stuff out. Make it happen. And yes, that is a Ritz cracker. I don't have the fancy crackers.